As we think about the growing risk of natural disasters, it's people working collaboratively together, thinking about ways to mitigate the risk.
Risk management and adaptation and planning is very important in terms of risk mitigation.
Hello, I'm Chandra Ghosal, and this is The Big Picture, a show where we answer the big questions facing global credit markets. Our topic today is how more frequent and more costly natural disasters are reshaping credit risk across economies, from rising insurance premiums and coverage gaps to growing demands for adaptation and resilience financing. We're going to focus on what's driving these increased costs, how they impact different sectors, and what those sectors are doing to respond. We've got the perfect guests today to dive deep into this conversation. I'd like to welcome my colleagues here at Moody's Ratings. Sarah Hibler is an Associate Managing Director on our North American Property and Casualty Insurance team. Sarah, thank you for joining us today.
Thanks for having me.
And Jennifer Chang, Senior Credit Officer and Global Lead for Physical Climate Risk on our Sustainable Finance team.
Glad to be here.
Jennifer, I'll start with you, and let me quickly set the stage. Swiss Re estimated that there was over $220 billion in economic losses resulting from natural disasters in 2025. What's driving that?
So there are a combination of factors, Chandra. 2025 was the sixth consecutive year where insured losses surpassed $100 billion US. In addition to seeing increased loss events, there are also other factors that are contributing to these losses, such as population growth and building development, as well as general cost increases. Many global cities are exposed to physical climate risk, and they're economically robust and also very populous. They have, however, benefited from investments in the past that have mitigated a lot of this risk exposure, be it flood defenses, reservoirs, etc.
And just to piggyback on this point for a second, these numbers are large, but can you contextualize them a little bit for us?
Just to give you a sense, LA, for example, there were 40 billion of insured losses last year as a result of the LA wildfires, and that's about 3 to 5% of GDP or so. So these are large numbers, although they seem small in terms of percentage of GDP. And then you take Hurricane Melissa that hit Jamaica in October of last year. It's about, I believe, 3 to 5 billion of insured losses, but estimated economic losses of 20 billion, which are the equivalent of basically 1 year's worth of GDP for the island.
It's really interesting, Jennifer, because the insurance industry, they don't know their cost of goods sold when they sell their product. The insurance industry in the United States covers a vast majority of the homeowners and commercial businesses in the country. And they tend to look at natural disasters. They look at historically what's happened, but they also run catastrophe models to figure out what could be coming or what hasn't yet happened. And so they're managing their books for what could happen relative to what historically has happened. So to give you an idea, Moody's published research on what would be the impact of a Cat 5 hurricane hitting Miami-Dade County. Now, this is a very low probability event, but that event could cause about $230 billion of estimated damages, which is roughly 13% of the state's GDP. And so insurers are thinking about not just risks that have happened, but sort of what are tail events that could happen to make sure they're around to pay their claims.
So insurance companies have to manage the risks. What are the types of things that insurance companies are doing in a climate where, the frequency and severity and the costs associated with these events are going up?
Well, insurance companies over the last, say, 3 or 4 years have had to raise their premium rates. Populations have been moving to higher risk areas, think sort of Florida or Texas, next to forests in California. Construction costs since the pandemic have gone up dramatically, both materials and labor. Insurers also manage their risk by buying reinsurance. Think of that as the insurance for insurance companies. And those costs have been going up. So not to mention increasing frequency and severity of catastrophes. So all of those have combined to result in insurers raising commercial property rates and homeowners rates pretty significantly over the last, say, 3 to 4 years. Homeowners rates, in 2023 and 2024 could have been low double-digit rate increases. They moderated a bit in 25, and in 2026, because insurers have improved the profitability of the homeowners line, we're expecting rate increases to be lower for consumers in the United States this year.
Jennifer, hearing that from Sarah tells me, okay, my homeowner's premium is going to go up a little bit, but by and large, I don't really have anything to worry about. Is that right?
Well, not necessarily. So there is also the element of the protection gap, right? I'm speaking of insurance protection gap, so losses that are not covered by insurance. And these can be quite significant, in particular in emerging markets where, there are rates of at least, at up to 90%, meaning 90% of losses are not insured, right? So the risk is really transferred to governments or individuals and businesses. But these high rates can also be seen in advanced economies. We've seen that in the southern Spain floods that happened in 2024. We saw this in Germany and surrounding countries in 2021, again related to flood. And we know that in the US, coastal cities don't have a very high uptake of flood insurance either. And, there could be underprotection, in that instance. For example, FEMA maps, they do consider riverine flooding as well as coastal flooding. But in situations of flash flooding, which we're seeing quite a bit, in particular in urban areas where basically, the amount of rain overtakes, sewage systems or drainage systems of a particular area, or just inadequate draining in general, those are not necessarily captured in FEMA flood maps. So there are a lot of properties or regions out there that could be not protected. They just don't have insurance coverage.
So there seems like a natural tension here because a lot of these places that are at risk are economically vital. Some of these coastal cities in the U.S. and in the emerging markets are places that have higher physical climate risks, are key economic engines for those regions or those countries. So they attract a population despite the increased physical climate risk, despite the increased costs of maybe moving to those areas, whether it's insurance premiums or the cost of building materials. So what are governments, policymakers, regulators potentially doing to kind of reconcile those two tensions?
So, it's an interesting point, Chandra, because historically, cities have been built in regions that have high risk exposure to physical climate risk, in particular coastal cities. And there are cities that have been built below sea level, for example. And for centuries, there have been investments made. And the reality is that we have to continue to make these investments as climate changes, as cities continue and regions continue to adjust. Investments in adaptation resilience it's really an ancient practice, right? But there is a continuous need to invest and maintain assets, infrastructure, and adapt as we continue to evolve.
Governments need to make the investments in the physical infrastructure to help mitigate these risks over the long term. What else can governments, and in particular maybe the regulators, do to help bridge these gaps or ameliorate some of these risks?
Well, I was going to follow up on what Jennifer said. So, for instance, after Hurricane Katrina, the levees were built or rebuilt. And when I think Ida came through Louisiana, those levees held and protected the city from a very large hurricane. And so that's an example of where building the infrastructure protects consumers and businesses. So where insurance companies traditionally haven't covered flood, that falls to the government. But in areas that have high physical climate risk, there are insurers of last resort. There are 33 of them in the United States. Now, historically, the coverage is likely more expensive, and you're getting less coverage than you would get from the private market.
If I can just add to something Sarah was just saying. So, governments have a lot of competing priorities, right, in terms of funding. So typically after a major catastrophe happens is when, there's a lot of focus in, risk mitigation and investments in these longer term plans. But the competing priorities such as education, housing, safety, transport tend to kind of drive the shorter term, funding and investment. But something to think about also is that typically these investments are framed as avoided loss in the future rather than actually benefiting economic growth and stability, including insurance market stability.
But as we think about the growing risk of natural disasters, it's people working collaboratively together. It's governments, it's businesses, it's homeowners, and it's the insurers and reinsurers thinking about ways to mitigate the risk or better protect, businesses and homeowners. One of the ways that insurers are involved is they're working with the Insurance Institute for Business and Home Safety to do research into building more resilient communities for both businesses and consumers. So, for instance, a relatively frequent one is protecting against wildfire, removing the brush from around your house, or better roofing material. And so one of the things that's been interesting is we all think about these major perils, hurricanes and earthquakes and the like. But really what's been happening, the majority of catastrophe losses have stemmed from these non-peak perils. Things like severe convective storms or winter storms or wildfires. Things that, particularly severe convective storms, where they're smaller events, but they're more frequent and they can add up to big exposures. And so thinking about ways to protect and rebuild or protect houses from hail damage, things like that can help reduce the risk.
I just wanted to go back on the point Sarah mentioned about the combined solution, right? The efforts, combined efforts. That's really important because we have seen that it's not just the private sector, it's not just the public sector that needs to invest, right? It's really a combination in addition to regulatory support, the insurance markets. And we have seen this benefiting, for example, regulated utilities in California that have suffered from wildfires, right? They have invested significantly after these events. They have benefited from regulatory support as well, in terms of cost recovery. They've also had a state wildfire fund that was put in place, which also benefits, right? Given the service area that they operate in is highly risky. So I think it is a combination of factors in order to really mitigate these risks.
So we talked about the frequency and severity of these risks increasing over the years. How are some governments or some cities dealing with this?
That's a great point because actually risk management and adaptation and planning is very important in terms of risk mitigation, right? So good governance in that respect can mitigate risk before, during, and after a major event. And that could be through alert systems, emergency preparation, building codes, as well as, no build zones, or even having relief funds, liquidity to, to withstand shocks, and just investments in general and maintenance for adaptation and resilience.
One of the interesting things is following some of the recent Florida hurricanes, the claims data shows that if your home was built to higher building standards or more recent building codes, you withstood that event and your losses were much, much lower than if you had an older home that wasn't up to the most recent building codes.
Sort of proving out the cost benefit of that proactive investment or improvement in the physical infrastructure.
Mm-hmm. Right, which is even in the case of insurance underwriters, right, reducing premiums, right, if you can demonstrate that you've actually built better or mitigated the risks, right?
Right.
So I wanted to ask both of you, what do the next 12 months look like? Let's start with you, Sarah, on the insurance side.
Insurers are entering 2026 in relatively good position, given the pricing increases that we've talked about, improvements in risk management, and rising net investment income from higher interest rates have all come together to boost their profitability and their capital. And so insurers are entering 2026, and what you're likely to see is that primary insurance companies are going to benefit from lower reinsurance rates. That in turn will, along with the profitability improvements they've made, will allow them to, in the case of commercial property, lower rates in general. Obviously, it varies by region and type of business, et cetera. And in general, you'll see homeowners' rates moderate as well because the profitability in those two lines has improved.
And Jennifer, what about you? What's your perspective from the sustainable finance front?
I think we're going to continue to see this focus on adaptation and resilience investments, right? And a little bit more detailed plans coming out from both, public sector and private as well. Seeing these investments, strategies for these, plans and investments being done at a little bit earlier stage of the investment phase, and also just increase overall understanding of risk exposure and risk vulnerability, again, on the part of both public and private sector. In addition, we'll continue to see the expansion of this innovative financing solutions, right, for adaptation and resilience investments. We have seen, for example, the climate debt relief clauses that were used in the Bahamas, which basically pause debt payments in the event of a shock or during the shock, and also debt for nature swaps, for example, used in Ecuador, where there is debt forgiveness in place of a commitment to invest in climate-related solutions, such as marine conservation, for example, as well as sustainable bonds.
Well, I think we should wrap it up there. We've covered a lot of ground today. Thank you, Sarah and Jennifer, for a really informative and interesting discussion.
Thanks for having us.
Thank you.
And thank you at home for joining today's show. You can find more information about our sector and global outlooks on our website. Until next time, this is The Big Picture.
By downloading or listening to this podcast, you are agreeing to Moody's legal terms and conditions found at moodys.com/disclaimer, including that the information provided is not investment or financial advice, and that Moody's will not be liable for losses arising from your use of the information.